When I turned 68, I realized my perspective on the investment world had changed considerably. The risks I took in my 40s would keep me up at night today. During the decades I spent at the top of JP Morgan, I weathered 3 major financial crises, watched markets collapse and recover, and witnessed entire asset classes vanish overnight. And the most important lesson I learned through all of this was, what truly matters in the later stages of life is not how much you earn, but how much you protect. When you're a young investor, time itself is a form of wealth. If you suffer a big loss in the market, you know you have decades to make it back. If a speculative investment goes to zero, you work harder, save more, and recover. But once you cross the 60 threshold, when retirement is approaching or has already begun, when you start drawing income from your investments, the rules of the game change completely. You're no longer trying to get rich. You're trying to stay rich. You're trying to preserve the wealth you've built through a lifetime of discipline. And a single wrong move at this stage can erase decades of savings. I worked with thousands of wealthy families at JP Morgan. Most of them were in their 60s, 70s, and 80s. I saw who succeeded and who experienced devastating outcomes. Some lost everything chasing high returns. Others lived prosperous lives by staying committed to simplicity and discipline. And those experiences showed me why the 3 core investment categories I'm going to share with you today are so critical. But first, I need to make something very important clear. When I say safe investment, I don't mean risk-free investment. There's no such thing. Cash loses value against inflation. Government bonds can decline in market value when interest rates rise. Even the most solid balance sheet stocks can pull back during market downturns. I define a safe investment as follows: assets that preserve your capital over time, generate predictable income, and have proven themselves through more than one economic crisis cycle. For someone who is past 60, these 3 characteristics are far more valuable than high return potential, because your margin for error is limited now, and you don't have decades ahead of you to make up for mistakes. The first and most foundational investment category is U.S. Treasury securities, specifically Treasury Inflation Protected Securities, known as TIPS. I know, I can probably guess what you're thinking. Government bonds are boring. They don't offer massive returns. You're not going to get rich investing in tips, but that's exactly why this instrument is so well suited for investors in the retirement phase. When you've passed 60, being boring is not a weakness. It means being resilient and strong. Being predictable means being in a position of power. Excitement falls behind safety. Now, let's go through step by step why tips should form the core of every retirement portfolio. The first reason is the full backing and guarantee of the U.S. government. Despite all its political uncertainties, its growing national debt, and the structural challenges it faces, the United States has never, not once in its 250-plus years of history, failed to meet its debt obligations. It cannot, because we're talking about a state that issues the world's reserve currency, hosts the most powerful military capacity, and has historically maintained the most stable political system. Whatever happens, however much the global economy is shaken, the American government will pay its bondholders. This is not a matter of fate. It's a structural reality. The second reason is that TIPS are specifically designed to fight against inflation, and this is vitally important for retirees. The principal value of TIPS adjusts upward with inflation, in line with the Consumer Price Index. So if inflation is 5% that year, your principal grows by 5%. If inflation climbs to 7%, your principal grows by 7%. Do you know why this is so critical for retirees living on fixed income? Because inflation is the silent value eroder of retirement portfolios. If you're living on a fixed income and inflation averages 3% annually, your purchasing power is cut in half in roughly 23 years. A healthy individual who retires at 65 may find by the time they're 880 that their standard of living has declined dramatically. They begin to worry about whether they'll have enough money for groceries, bills, and healthcare. With TIPS, this concern is largely eliminated. Your income adjusts automatically with inflation, and your purchasing power is preserved. The third reason is the real return levels that TIPS offer today. Real return refers to the net gain you earn above inflation. For most of the past decade, TIPS offered negative real returns, which in practice meant you were handing your capital over to the government just to preserve its value. But today you can find TIPS offering real returns of between 2 and 2.5%. This means you're achieving a real and tangible gain above inflation. At JP Morgan, Dividend, we recommend that clients who have crossed the 60 threshold allocate between 40 and 60% of their portfolio to tips. This range varies depending on other income sources and risk tolerance. If your pension or social security income is strong and stable, 40% may be sufficient. But if you're covering most of your living expenses from your investments, 60% or above puts you in a much safer position. The second core investment category is high-quality corporate bonds from well-established and financially sound companies. While government bonds are stronger in terms of credit risk, corporate bonds generally offer higher yields. If you're funding your living expenses from your portfolio income, this yield difference has a significant impact on your standard of living. But be careful. It is not the right strategy to move into just any corporate bond simply because it offers a higher yield. You must be extremely selective. It is essential to focus on businesses with strong balance sheets, predictable cash flows, and a track record of meeting their long-term obligations without difficulty. At J.P. Morgan, when we analyze corporate bonds for retirement portfolios, we examine financial strength, business model stability, and management quality. The companies that meet these criteria are typically large, well-established institutions with dominant market positions and predictable earnings streams. Let's talk about concrete examples. Think of companies like Johnson & Johnson, which has grown its dividend for 59 consecutive years and holds one of the strongest balance sheets in the healthcare sector, or Microsoft, which generates sustainable cash flows through its cloud infrastructure and software model, or Coca-Cola, which has been paying dividends for over a century and whose global brand strength is nearly unrivaled. The bonds issued by these companies typically offer 1 to 2% more yield than equivalent government bonds. Their credit quality is nearly as strong as government bonds. Default risk is extremely low, and this additional yield can meaningfully elevate your retirement income. For those who have passed 60, I recommend allocating 15 to 25% of the portfolio to high-quality corporate bonds. A diversified portfolio structure spread across different companies and sectors should be built, but priority should go to companies with the highest credit ratings. One important point to watch with corporate bonds is interest rate risk. When interest rates move up, bond prices fall. But if you're planning to hold the bonds to maturity, this doesn't actually affect you in a real sense, because at maturity you will have your principal back, and interim market price fluctuations don't bind you. That is one of the greatest advantages of the long-term investor, being able to filter out short-term noise. The third and final core investment category is shares of companies that have long paid stable dividends and operate with conservative business models. Right now you might be asking yourself, stocks aren't safe. Stocks are volatile. Stocks can lose 30 to 40% in a market crisis. Yes, all of that is true, but when we're talking about specific types of stocks, specifically dividend-paying stocks of well-established companies, the risk profile looks very different from broad market averages. The secret here is focusing on companies with defensive characteristics. These are businesses that offer essential products and services that individuals need, regardless of economic conditions. Utility companies providing electricity and water, consumer staples companies producing food and household goods, healthcare companies offering essential medical services. These companies tend to generate stable income and strong cash flows even during economic contractions. Although the shares of these companies that consistently pay dividends do fluctuate, they display far less volatility compared to general market movements. Let's move on to concrete examples. Take Procter & Gamble, which produces everyday consumer products like Tide detergent and Crest toothpaste. Even during downturns, consumers don't give up these products. The company has been distributing dividends for over 130 years and has been increasing its dividend uninterrupted for 67 years. Another example is NextEra Energy, one of America's leading electric utility companies. During economic downturns, consumers don't give up using electricity. The company has a regulated business model, generates predictable cash flows, and has increased its dividend for 28 consecutive years. These types of stocks serve two critical functions in a retirement portfolio. First, they provide current income through dividends. The vast majority of these companies offer dividend yields of between 3 and 5%, and this income nicely complements your bond income. Second, they offer a partial shield against inflation. Because these companies are generally able to raise their prices when costs increase, which helps helps shareholders preserve their purchasing power. For investors who have passed 60, I recommend allocating 20 to 30% of the portfolio to dividend-paying stocks, but with a critical warning attached. Be extremely selective. Focus only on businesses with the longest dividend payment histories and the highest quality. Accept from the outset that stock prices will fluctuate. It's unavoidable. Even during the 2008 financial crisis, conservative utility stocks fell by around 20 to 30%. During the 2020 pandemic, many dividend stocks suffered significant short-term losses. But don't forget, if you own high-quality dividend stocks and you're not forced to sell during market downturns, you can simply collect the dividends and wait for prices to recover. And in good companies, prices have always recovered. Now I want to address the mistakes that investors who have passed 60 frequently make. These mistakes are extremely common and can lead to catastrophe. The first and perhaps most dangerous mistake is ignoring risk in the pursuit of high returns. During periods of low interest rates, many retirees grow tired of the limited returns offered by safe investments and turn toward riskier alternatives. High-yield bonds, preferred stocks, dividend stocks of financially weak companies, real estate investment trusts. The problem is this: high returns almost always come with high risk, and once you've passed 60, it's not appropriate to take those kinds of risks with money you need for basic living expenses. At JP Morgan, during the low-rate environment of 2010 to 2020, I had countless conversations with clients who wanted to buy high-yield bonds or stocks from financially weak companies. They were putting their principal at risk to capture that extra 2 or 3% yield, but they didn't want to see it. Don't make this mistake. Earning 3% safely is far more valuable than chasing 6% and losing 30% of your capital in the process. The second mistake is trying to time the market. Many retirees think they can grow their returns by getting in and out of the market at the right moments. They sell when markets fall and buy again when they rise. This is exactly the opposite of what should be done, and almost always leads to weak returns. With over 40 years of market experience in the large analyst teams I managed at JP Morgan, I can say this: market timing doesn't work even for professionals. For individual investors, especially retirees managing their own portfolios, it is a recipe for disaster. The third mistake is overconfidence. Successful business people or professionals who have reached the top of their careers assume their experience from the business world can be transferred to the investment world. They try to pick individual stocks or find the next hot sector. But investing in public markets requires a completely different skill set from starting a business or specializing in a professional field like medicine or engineering. Deep analysis of financial statements, understanding industry dynamics, mastering valuation methods and macroeconomic trends are all essential. Many investors don't have this expertise, and the result is costly mistakes. The fourth mistake is neglecting diversification. I see many retirees overloading on their former employer's stock because they think they know that company well, or they invest only in America-focused assets because they don't understand international markets, or they avoid bonds entirely because they believe stocks always deliver better returns. Proper diversification across asset classes, geographies, and individual securities is critically important for managing risk, especially for the post-60 period, when there's no time left to make up for major losses. The fifth mistake is neglecting the tax dimension. Most retirees don't plan carefully enough about which investments to hold in taxable accounts and which in tax-deferred accounts like IRAs and 401ks. Your tax situation in retirement can be very different from your working years. You may be in a lower tax bracket, which can make Roth IRA conversions attractive. Holding tax-inefficient investments in tax-deferred accounts and tax-efficient investments in taxable accounts is a sound strategy. Now I'd like to address some macroeconomic concerns that affect everyone who is past 60. The first is the inflation issue. After decades of relatively low inflation, we're observing inflationary pressures beginning to climb again. Although inflation has eased from its peak, I believe we are in a period of structurally higher inflation due to deglobalization, aging demographics, massive public debt loads, and the weaponization of the dollar. This is particularly worrying for retirees living on fixed incomes. That's exactly why tips and dividend stocks are so important. They provide real protection against rising prices. The second concern is longevity risk. People are living longer with each passing day. Today, 50% 25% of healthy 65-year-olds have a chance of living to 90, and 25% have a chance of living to 95. This means a retirement portfolio may need to remain sufficient for 30 years or more. This creates a serious dilemma. The portfolio needs to grow over time to preserve purchasing power, but it also must be conservative enough to avoid large losses. The balanced combination of TIPS, high-quality corporate bonds, and dividend stocks stands out as the most appropriate structure to achieve this balance. The third concern is healthcare expenses. Healthcare costs tend to rise with age and often increase faster than general inflation. Long-term care expenses can be devastatingly ruinous to retirement portfolios. For this reason, building a conservative budget plan, setting aside a specific portion of the portfolio for healthcare expenses, is of great importance. Some retirees turn to long-term care insurance, but this insurance is becoming increasingly expensive, and its coverage is narrow. Now I'd like to offer concrete suggestions on how to put this investment strategy into practice. The first step begins with identifying your income needs. Calculate how much money you need annually to cover your basic needs: housing, food, bills, healthcare, transportation. This is your survival budget. You want to meet this need with the safest possible investments, such as TIPS, and high-quality corporate bonds. The second step is determining how much additional income you need to maintain the standard of living you desire. Travel, entertainment, gifts to family members, charitable donations may all be part of this. You can meet this need with income from dividend stocks and additional bonds. The third step is building a liquid cash reserve for emergencies. It's useful to keep an amount equivalent to 6 to 12 months of your expenses in a high-yield savings account or short-term treasury bills. This gives you both flexibility and peace of mind. The fourth step is periodically rebalancing your portfolio. Asset allocation is often a more decisive factor than security selection. As market fluctuations shift your target weightings, you need to bring the portfolio back to its strategically defined allocation. If stocks perform strongly and climb above the target allocation, sell some and buy bonds. If bonds gain weight, increase the equity side. The fifth step is considering working with a fee-only financial advisor who specializes in retirement planning. This is particularly important if you have a large portfolio or a complex financial situation. Make sure the advisor serves in a fiduciary capacity, legally obligated to act in your best interests. I also want to clarify the question of how much income you can withdraw from your portfolio. The traditional rule pointed to 4%, but that framework was shaped during a period of higher interest rates and bond yields. In today's conditions, I find 3 to 3.5% more prudent as an initial withdrawal rate, bearing in mind that you may need to adjust your spending based on market conditions and portfolio performance. The flexibility provided by a balanced approach comes into play precisely at this point. If stocks have a weak year, it's possible to reduce withdrawals from that side of the portfolio and lean more heavily on bond income. If bonds lose value in a rising rate environment, you can rely more on equity dividends. This flexibility is the most rational way to protect your portfolio. Finally, I want to emphasize the importance of staying disciplined and not being swept up by market euphoria or panic. The media constantly places before you new investment themes, hot sectors, or crisis scenarios that supposedly require dramatic portfolio changes. Don't get caught up in this noise. Stay anchored to the fundamentals. Maintain your allocation of TIPS, high-quality corporate bonds, and dividend-paying stocks. Make gradual adjustments as your circumstances change, but don't make dramatic moves because of short-term market movements or media headlines. Remember, at this stage of life, your goal is not maximum return. It's to preserve capital and generate income. You want to sleep soundly at night knowing that your portfolio can sustain your lifestyle no matter what happens in the markets. These three investment categories, TIPS, high-quality corporate bonds, and dividend-paying stocks, have provided security and income to retirees through every market cycle and every economic crisis in modern history. They're not exciting, they're not flashy, but they are functional. And when you've passed 60, being functional is far more valuable than being exciting. The choice is yours. You can follow today's investment trend and put your financial security at risk. Or you can stay committed to a time-tested framework that has protected and sustained retirees for generations. I know what I will choose. I know what I am choosing today, and I know what I will recommend to my own family members when they reach retirement age. The real question is, which path will you choose?